Why is real estate? Why is real estate such a great vehicle for creating long-term wealth?
You know, it's amazing. I was reading a couple of articles this morning, and it's interesting that there's a whole lot of discussion going on at the moment about how far interest rates are going to go up, and the same professionals that have made these outlandish comments in years gone by, and they've been proved totally wrong time and time again, are now coming out saying, we're going to have 9, 10, 12% interest rates.
Back to where it was in.
Yeah, that's right. And, you'd love to debate the issue with them because there's no grounds for it. And you can bet your life that in 6 months' time or even less, these people are going to be turning around probably saying the opposite. And even yesterday, someone came out talking about interest rates, and there's a couple of experts saying they believe the next interest rate move will be down, not up.
Yeah, I've heard that too.
Yeah, it's very confusing for people. I mean, we have our own opinion, but no one has a crystal ball. So, it's one of those things. But look, generally real estate doubles every 7 to 10 years. It has done right throughout history. And unless history completely changes, it's going to continue to, even though people say, no, it can't keep going up. Well, it always has, and it always will. It's just the nature of real estate. And of course, the volatility of other investment alternatives like the share market. I mean, we experienced the global financial crisis, and we're sort of re-experiencing some of that, particularly in the share market at the moment, with huge drops in America and following on in the Dow Jones, in the All Ordinaries in Australia. So, it's a very volatile market, the share market, and even the best people. And I know I've had a fair bit of experience with the share market, and I know people who are very, very good at trading shares, and they've almost lost their shirts as well. So it's it's something that you've got to be really careful of. And property just doesn't have that volatility.
No, and you can always borrow against property, which is what I like.
That's right.
And instead of controlling $100,000 worth of shares, you need $100,000
right.
to hold those shares.
Yep.
You can leverage $10,000 and buy $100,000 property, and so on and so on. So
use someone else's money.
Yeah, leverage, the power of leverage.
Absolutely.
Okay. The fear of investing. The fear of investing tends to hold a lot of people back. What would you say to those people controlled by fear?
Yeah, it's a huge one, this one. We meet so many people that procrastinate. We call it analysis paralysis. They spend years and years and years and years analysing things but never actually take action. And we try and encourage them to take action because, let's face it, you and I both know you can analyse things up to a certain point. But when you get to that point, you can't just keep analysing. You've got to take some action if you want to get anywhere. So, and it's that fear that really gets people. And you can overcome that really by educating yourself, making sure that, borrowing money with what we call good debt is a good thing versus bad debt, which is not a good thing. So, if you're going to go out and spend your money and borrow money on cars and big television screens and all that sort of stuff, they don't go up in value. They don't give you a tax advantage. So, but if you're borrowing for good stuff and what we call good debt, where, as you mentioned before, Lee, the leveraging, leveraging, buying property, putting down a deposit and using someone else's money, then that's good debt. And once you get used to that, it really just becomes second nature to you. You sort of start out, you might borrow $300,000 or $400,000 for a property, and after a while you own a dozen properties and you might owe $4 million. And it's surprising just how comfortable you can get with that when you know that your investments are going up in value almost every night. So, the fear of investing is something that people need to overcome to be able to do anything, but it's through education that they need to do these things. Yeah.
Okay.
We always say that, if you owe the bank $100,000, then you've got a problem. But if you owe them $1 million, then potentially they've got a problem. So probably the more you owe them, the better.
Yeah, okay. So get in or borrow your second one. Get your third one going. Come on.
Right.
Let's talk about retiring. Why is it important for people in the younger generation to start thinking about retiring earlier?
Yeah, look, when we meet with our clients, we sit down for an hour or so, we talk about things like retiring, and they tend to think that it's when you turn 60 or 65 or even 55, but it doesn't have to be. What we're talking about when we talk about retirement is retiring far earlier than you thought was ever possible. So you could be 25 now and you might be looking at retiring in 10 years. So, retiring at 35 or 40 instead of 60. Huge difference. And there are low risk strategies you can put in place. And those strategies, as we know, generally speaking, property doubles in value every 7 to 10 years. So in 7 to 10 years from now, even if someone was 55 now, by the time they were 65, they could be totally self-supporting in financial terms, rather than relying on the pension, which is, $250 a week or something.
Yeah, I think it's even low. I think it was $194 a week. I think that's with two people these days.
It's absolutely
and that's
crazy.
now. By the time an average 30-year-old gets to 60, what trouble are we going to be then?
That's right. Yeah. Will there be a pension at all?
Well, you better hurry up and save. Self-sufficient.
I don't know about you, but I don't want to live on a couple of $100.
I can't live on a couple of $100
that's
now. Right. Okay. Why is research key when investing in real estate? And what are some of the research tools people can use to help them improve their investment decisions?
Yeah, as we've mentioned a couple of times already, research really is the holy grail. It's where you make the money or where you lose the money. So it's really, really important to do your due diligence, check things out, find out, set your goals, find out where you want to buy, the type of property you want to buy, research that property, research the area, and there's a whole range of things that you need to do and a range of tools. Some of the tools that just about anyone can use are, property magazines. Australian Property Investor is a really good magazine. We encourage all our clients to get that one. And it's got some great case studies of people, people who've made mistakes and people who've been successful. So it's not, all one way. It's a balanced view.
Yep.
And newsletters, if you can sign up to, there's lots and lots of free newsletters around. Ours is one, of course. One of the better ones.
Yes, of course.
Residex is one of the most reliable sources of information, and we've got a fairly strong link with that organisation. So we do encourage people to look at Residex. They've got various reports that you can buy from them. Yes, you do have to buy them, but they're absolutely brilliant and they're so well researched. And websites like realestate.com, domain.com, Homehound, those sorts of sites as well, where people can get a lot of very good general information. Also some of the government sites, the government websites, local government planning, and when you go in there you can start to get an idea of the sorts of infrastructure that might be going into the area.
And that is key, isn't it?
Absolutely.
Like highways and shopping centres and stuff, because fair enough, there might be the worst house in the best street with no shopping centre around, but if you know that there's a shopping centre around, the potential for increasing your wealth on your property it goes up tenfold.
Oh, yeah. Huge, absolutely huge. So it's certainly well worth checking out.
Okay. When looking for real estate, what do you look for in a property and why?
We've developed a couple of checklists which has sort of taken us through experience. It's not through reading books and things like that, but just through experience, which has probably taken us 15, 20 years. And some of the key things which probably aren't surprising to most people, but things like checking out the transport. You've got to look at your target market. You're going to buy a property, you're going to rent it out to someone. So those people are normal, everyday human beings, just like you and I. So they want access to things like transport, and if they're a family, then they're wanting access to education facilities, things like schools, primary schools, high schools, maybe TAFE colleges, universities, those sorts of things. Health facilities, particularly for families, if you're targeting families, and most tenants you'll find are families with young children. Employment, access to employment. The employment doesn't have to be in the same suburb, but I guess linked in with the transport, it has to have easy access to it because they don't want to be spending hours and hours, travelling to get to their employment. Check out the population growth, and that's pretty easy to do with the Australian Bureau of Statistics. They have some very good reports. And really what you're looking for is a net population growth. In other words, most people say, well, a particular suburb has grown by 100,000 people. But what they're talking about is that 100,000 people have come in, but they forget that 150 have gone out. So, there's a net population loss, if you like. So you don't want suburbs like that. You want that net population growth. And, of course, low rental